I've got a question. Did you make money from this crash? It might sound like adding insult to injury, but if we want to survive in any market long term, we have to get less and less directional exposure and instead trade the imbalances. For example, here on this channel, we did make money from this crash. We all know how it started. MicroStrategy sold some Bitcoin, and he might be regretting that now. The entire market is going bonkers, and the answer is not to try to find the few winners here. I'm not saying that I bought the home token, or that I bought Jito, or that I was lucky to pick WorldCoin. There's a different way. There are a lot of inefficiencies in crypto, and this time I'm not talking about shorting altcoins. You might know that I like to do that. This time I'm talking about something else. Hi, my name is Gerhard. I've been in the crypto space for the last 8 years. I hit my first million 3 years ago. In this video, I want to share the approaches that I personally use in order to beat the market, even during turbulent times like this. This was clearly a crash led by Bitcoin. Bitcoin underperformed the rest of the market. Bitcoin dominance, that's what we're seeing here, went clearly down. But our portfolio actually hit an all-time high. In orange, we see the positions that are currently open. This is my track record over the last 2 years, so 175 trades. Now, I'm not showing the currently running trades, that's for the premium members, but every single trade that I have made over the last 2 years, they are 100% transparent and can be verified over here. I don't know many other people that are willing to go to that kind of length, maybe because not everybody publishing videos here is actually a winning trader. But yeah, every single trade is also connected with a Telegram message. So for example, here when we shorted the Pudgy Penguins token, that was on the 8th of May. We subsequently then closed that. That was on the 23rd of May, and we used some backtesting to find the perfect entry and exit for that short position when we bet on falling prices. So all of this is transparent. The reason why I show this here at the beginning of the video is simply to be transparent. Now, the reason why we got out of Bitcoin relatively early before that crash happened is because of our backtests. So we've got optimized leverage, we've got optimizations of golden and dev crosses, the performance over time. But I don't want to talk about market timing here. I want to talk about generating alpha that's relatively independent of price movements. For example, over here, I already mentioned this in a prior video. What we see here, that's US oil relative to European oil. So WTI divided by Brent. We've got a long-term average, that's a dotted line. Sometimes US oil is more expensive compared to the equilibrium. Sometimes it's rather cheap compared to the equilibrium. We are not trying to predict where the oil price is going. We are just trading the ratio. We just trust that long-term, those are substitute products that tend to trade back to a balanced price. And when there's simply not that much of a balance, then we go long one asset, short the other, and trade it when we are out of balance. That way, we simply pick up a few percent here and there. This is 4% here, this is another 3% here, this is another 4%, or rather 3.5%. So we always just pick up this delta. And we do this several times a year, thus making money without too much price exposure. We can also use a similar approach for agricultural commodities. So let's say cacao versus coffee, right? We've got similar kinds of inputs. We've got land, we've got labor, we've got energy. And of course, both tend to go up when energy prices go up, but the ratio between the two should be very long term, at least be somewhat stable. So when cacao is cheap relative to coffee, we can potentially make an almost 100% gain, and vice versa. When cacao is expensive relative to coffee, we bet on the falling price of cacao and then we long coffee. Now, the reason why I show this again is not just to republish again what I've already talked about prior on this channel. What I want to do is rather set the stage for trading approaches where we are not so much exposed to price fluctuations. We can make money without predicting prices. We can do this relatively constantly, and we can achieve quite high APYs as well. This here might sound scary, but it's actually not that complicated. Have a look at interest rate arbitrage. On the perpetual futures market, so on Hyperliquid, for example, it costs money to go long for most assets. So we've got a funding rate. Whenever we trade something, we have to pay the longs. That's when the funding rate is positive. When the funding rate is negative, then we're paying the shorts. So right now, for example, for Nvidia stock, tokenized Nvidia stock, there is a funding rate of 21%. If you currently want to bet on a rising Nvidia price, you are paying 21% per annum. Now, paying 21% per annum doesn't necessarily sound that attractive, but getting 21% per annum maybe does. especially if we can lever this up, right? We can 5x lever, for example, a position on hyperliquid. Suddenly, we've got 100% per annum. Now, that's unfortunately only one side of the trade, right? If we now short Nvidia, if we bet on falling prices of Nvidia, yes, we get the 20% per annum, but we are exposed to the price. So if we want to be completely neutral to the market, we have to set up the counter position. Now, we want to set up that counter position without paying all of those fees, or at least paying less than 21% per annum. And in traditional finance, we can, right? We can have a margin account, say on interactive brokers, and there we pay maybe only 6%, or if you have a pro account, only 4% per annum. So we go long with a margin account on interactive brokers, pay 4%, and then we go short on hyperliquid, and we get more than 20% per annum. That's then a delta of say 15%. Let's 5x that with a bit of leverage. Suddenly we have 75% per annum. And that's without any price risk. So where's the catch here, right? Earning such a high APY is not without risk. Where are the risks? The first risk is, of course, hyperliquid, right? Hyperliquid is still a decentralized finance protocol and it could get hacked any point in time. We could potentially lose our funds. It has happened with prior DeFi hacks as well. But just because something has a risk doesn't mean we shouldn't do it. We just have to calculate this within our expected returns, right? If our expected return is only 5% per annum, it might not make sense to invest in something like this. But if our return is 50% or even 100% per annum, then this does make sense as an addition to a portfolio. Not to put all funds in there, but as an addition. A platform like Hyperliquid will not lose all of its funds every second year. The second big gotcha here is that those funding rates, they update every single hour. So while we might have high funding rates right now that we can potentially earn, we might not have this in the next hour. And so that's the fundamental issue. We have to trade, right? We buy the asset, we have to sell the asset. We have two sides of the trade on two different platforms in two different universes. We pay those fees and we don't necessarily earn enough funding rates to pay for the fees if we rebalance too often. So what matters here is, what is the funding rate long term? How does the funding rate develop? And Hyperliquid is not transparent with this at all. It just shows the current funding rate. But here comes Bitcoin Strategy Analytics, the backtesting platform of this channel. It's available to all the premium members of this channel. There's a new funding rate arbitrage mode over here. And I'm currently hiding the assets because I don't want to spoil the results here for the free YouTube channel. So you don't see the exact assets over here, but you can see that over the course, in this case of the last week, there are assets that on average had a 40% funding rate. So we would go short that asset in Hyperliquid and then we buy that asset in traditional finance. And then we are making the spread. So let's say you pay 5% for your traditional finance margin account. You get the 40%, you have a 35% delta without even any leverage yet, right? If you just 3x lever that, which is totally possible given that we are completely delta neutral, you are doubling your capital every single year. Now, how much does this fluctuate? Let's have a look at this particular asset. Over here, we've got the daily funding rate. So yes, this does go down sometimes. Over the last 1.5 months, it tended to be positive. Now that's the daily funding rate. We can also have a look at the weekly funding rate. So there seems to be some clustering, as in there are times when it's negative, there are times when it's positive. Currently, it's clearly positive. Are we going to get those 50% indefinitely in the future? Not necessarily, right? This is a very volatile asset. It gives nice funding rates. But is it likely that the next bars will all be negative? Probably not either. And even if it was to fluctuate at around 20, still, we just lever this up slightly and this is a very nice APY. Now there are assets that are a bit less volatile. This one, for example, this has currently a very high weekly APY. It is not all science. There is a bit of art to this as well, what kind of asset we want to choose. But in general, I very much like this approach. You can also have a look at the funding window, say over the last month. What's the annualized return? The very best one was actually a commodity. So you would be shorting that commodity on Hyperliquid and then buying it in traditional finance. We can also do the exact opposite. There are some commodities and some stocks that have a negative funding rate. So in this case, we want to go long on Hyperliquid and then we want to short in our brokerage account. There's also an overview grid over here that you can then have a look at the different assets and how the funding rate fluctuates over time. and what the average funding rate that we can expect will be going forward, right? Some of those assets have very predictable positive funding rates, and some of them are a bit more risky. Now, why are we making money here? Who are we making money from? When we are shorting an asset on Hyperliquid that's currently very popular on the platform, we are basically making money from all of those short-term traders. The short-term traders, for example, want to get access to a particular technology stock. Their technology stock might be available on Hyperliquid. They might not have a brokerage account, and so they simply just use leverage to buy that stock. We then, on the other hand, we can buy the stock with our brokerage account. We just take the counter position and we collect the funding rate from all of those active traders that are only staying in crypto. The real opportunity, I say this very often on this channel, is not just to stay within an asset class. Yes, this is the Bitcoin strategy channel, but I like to be diversified across different strategies and across different asset classes. I do own property, I do own precious metals, I do own stocks, I do own crypto as well. But the magic happens always when we go cross asset classes. That's where we, for example, get most diversification, right? Within crypto, we see a lot of correlation. Within the stock market, we see a lot of correlation, but not necessarily that much correlation between, say, the property market and precious metals and crypto, right? They might be moving in different directions at the same time. If we want to spread our risk, we buy different asset classes. If we want to make money, we want to take advantage of inefficiencies. Very often, those inefficiencies are across asset classes. And in this case, it's the perpetual futures market in crypto versus traditional finance. The reason why I'm so much focused on the crypto market is not necessarily because I love Bitcoin. It's just because this is the most inefficient market. Those kinds of interest rate arbitrages are impossible to find within traditional finance. But once we cross the barrier and we go from crypto to traditional finance, it is obviously possible. Now again, I'm currently blurring all of this data over here, but I just want to inspire you with this video to not always focus so much on timing the market, to rather look for opportunities elsewhere. And those opportunities can have plenty of return. If you want to get specifically deeper into this particular strategy, then feel free to, of course, check out Premium. This is where there are the results. This is also where there's a dedicated tutorial video where I explain everything in more steps. A link to Premium pops up here on the screen. There is a 7-day money back guarantee. In case you don't like it, just message me within the first 7 days. I'll refund you. But I'm quite certain if you just open up 2 or 3 trades of those relative valuations, right, this interest rate arbitrage, you're very likely going to make the money back extremely quickly. On average, the premium members of this channel stay subscribed for roughly 1.5 years. That's the average. Some people have signed up and they've never quit, and others they quit directly after the first or second month because they don't want to learn anything. But in general, I think those kind of numbers don't lie. If you're an active trader and you like to just plainly copy trade whatever I do, then feel free to come. But even if you don't want to have any price exposure, if you're willing to invest the time, superior returns are waiting for you. If it is your very first time here, then feel free to subscribe. I publish here regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time. Cheers.